Welcome back to U.S. Farm Report. Duwayne, Bosse, and Arlan Suderman joining us this weekend. We started off initially talking a little bit about the WASDE report earlier this week. And let's talk about what it means for price action. Arlan, let's talk about soybeans and the ratio between corn and soybeans. Where do we need to be right now? Because we have a lot different dynamics in terms of ending stocks between corn and soybeans at this point.
Yeah, first of all, let's get out of our mind that the old crop ratio really matters that much, other than a psychological factor. It really comes down to the new crop ratio as far as determining next year's acreage. And typically we're going to run 2.35 up to maybe 2.5 or so for that new crop soybean corn price ratio. But we've taken it as over 3 several times in the last 15 or 20 years. So it can happen. We can get up to 3.1, 3.2 or so. It's rare, it doesn't happen often, but it can happen. The bottom line is right now, soybeans is what is going to be driving it. And so you say, will that hold up corn? Probably will not hold up corn to the extent that farmers would like, but it does have a psychological impact. And I'll give an example. When the report came out on Wednesday, the corn numbers are really no surprise, but we sold off hard. That's because the support from wheat and soybean prices had broken. And so therefore corn was allowed to fall. Corn, soybeans and wheat had been helping prop up corn prior to that point. So it does have an effect on it. You need to have strong soybeans to hold up corn at this point. And we just simply don't have the fundamentals to do it otherwise yet.
Yeah, it looks like it's going to be a bit of a tug of war there. So Duwayne, let's talk about soybeans, because $14 November beans, that seems to be kind of capping the rally here because of what we're seeing in terms of the ending stocks figure. Do you think that we're going to need some sort of a weather problem to get back above that level?
Yeah, I think it would take some sort of drought scare, some heat ridge in August, and then threaten the yield, right? Then we could get above $14. Before that, I don't see a reason why we have to do that yet. Like, the new crop ending stocks are tight. I mean, 300 million bushels, even if we believe it or not, is fairly tight. So we're justified being in this range here, but honestly, above 1350, I'm okay to be a hedger of new crop beans. And because of that tightness, we don't really have to drop below 12 bucks anytime soon either.
And as far as the corn market, if you're above 2 billion bushels, is $5 a justifiable level for corn?
Sorry, producer friends out there, but no, I really don't think so. Like I said, because of what I'm forecasting, a much lower export demand number for corn, I'm looking at corn prices going lower to maybe even sharply lower from here. But to Arlan's point, maybe soybeans can help them out for a little bit until we get to fall. But corn in a bubble by itself could trade down 425 on the future side.
Yeah. So the other thing that was friendly for commodities this week was the CPI levels. And Arlan, do you think that right now this will cause the Fed maybe to back off? And talk about what that meant for the dollar falling below par here and what that means for commodities.
Well, their perception is reality. And right now the market is perceiving that this gives the Fed the permission to pivot its policy. It's got about a 92% odds in Fed futures trading that we're going to see one more rate hike as we get toward the end of this month from the Federal Reserve. And then that's it. And we start cutting rates in the first quarter next year. That's the market's perception. Keep in mind that the market's been wrong for the last year and a half or more. And I think it's going to continue to be wrong. And the reason is because we have that 2% mandate that the Fed is committed to. And while we're seeing many of the factors of inflation go away, one of the key factors that it's not, and there's really two that are not, that shelter that made up 70% of this past week's CPI number that we saw. And then there's wage inflation, which shows up in the service sector. Now, we anticipate that shelter is going to go lower. There's certainly indications that it's going to go lower, but we are starting to see that housing market heat up again, and we have a shortage of housing in the United States. And as the consumers become comfortable with higher interest rates and consumer sentiment has started to work higher as a result of reports like this, they're starting to go back in the housing market and they have to pay up for those houses. But wage inflation is the big problem right now. We've not been able to balance supply and demand there. And I think the Fed's going to have to inflict more pain on the economy in order to get down to the 2% level.
Yeah, and the reason we talk about it is it does impact money flow. And, cattle are sensitive to that as well. And we did have kind of a big key reversal in live cattle futures on Wednesday. Duwayne, what do you think? Did we put in a blow off top there, or is this just, one of those things that when you're in a supply type market, doesn't matter technically?
Well, we are sure in a tight market there, aren't we? No, but it's been an odd week, right? We ran up and made new highs when I felt like we didn't have to, according to the fundamentals. Box beef going lower, cash markets trending lower, dog days of summer. You'd think we just grind lower on the futures market, but yeah, we did this big spike up and then a hard reversal. It does look like a blow off top right now, but stay tuned. We've said that a couple times this spring already.
Arlan, is this situation different than what we saw in the 14-15 cycle? Does it have a longer tail?
I think it does have a longer tail. And let's keep in mind that we have not yet really started to hold back heifers. We're still slaughtering 65,000 to 70,000 head of cows per week. So we really haven't cut back on the cow slaughter either. And once that happens, we're going to tighten up those beef supplies even more. And the market's really not taking that account. And that has implications for feed market. Duwayne was talking about exports. I'm really concerned about USDA's feed usage number for corn being too high for this coming year as well.
All right, thanks for joining us this weekend, Arlan Suderman and Duwayne Bosse, and we'll have more U.S. Farm Report coming up.